All right, everybody, thanks for joining us. And we are here for the Digital Asset Treasury State of the Union, otherwise known as the DATS State of the Union. Very excited to have an esteemed panel. I'll start with you, Ben, and just introduce yourself and just love to hear about what's your relevancy towards the DAT world.
Yeah, Ben Forman, is my mic on?
Yeah.
Okay, great.
Yeah.
Ben Forman, I'm the founder and managing partner of Parify Capital. We manage a little over $2 billion across public and private markets, all focused in crypto. We did our first DAT deal in January of this year, Sol Strategies, which is a Canadian-based issuer. Since we've done 25 to 30 different DAT deals. We've done pipes, converts, preferreds. We've also done deals outside of the US, so South Korea, Brazil, London, back Jeff on this, in his new DAT, have done deals with Christian, have co-invested with Seth. So, you know, we've seen the good, the bad, and the ugly of the DAT world, and excited to talk about it.
Love it. Hi, everyone. My name is Jeff Park, and I am the CIO of ProCap, which is one of the Bitcoin treasury companies that will go online hopefully later this year if the SEC were to ever reopen, God willing. Before that, I was at Bitwise. I was the head of Alpha Strategies, and very happy to be here.
Hey, everybody. Christian Lopez. I am a managing director and head of digital assets at Cohen & Company. Cohen is an investment bank, kind of full service, capital markets, M&A, strategic advisory. You know, a big focus of ours is the digital asset and crypto industry. We've done, you know, I think over a dozen DATs, led over a dozen DATs from an investment banking standpoint this year. Worked with Jeff's team, worked with these guys across as investors, as principals and sponsors. Seen every type of structure, from SPACs to RTOs to pipes into vehicles. And I think we understand, you know, the playbook that works and what doesn't. But it's been a whirlwind so far. But yeah, that's me.
Hey, Seth Gaines, managing partner at Coin Fund. I run our liquid fund, friends with everyone on stage here. Coin Fund, we have just under 2 billion AUM across venture and liquid. And on the liquid side, we have backgrounds in public equities. So I was a large cap growth investor for 18 years before coming full-time into crypto. So DATs kind of made a lot of sense to our team. And we've been fairly prolific investors across the DAT space. So again, lots of perspectives on what's working, what's not, what the future looks like for DATs.
Amazing. So it's funny, at the last Digital Asset Summit, I also hosted a DAT panel. And at that time, this was, I believe, in March. So the meta was really just starting to get going. But that panel was a lot of just getting into some of the basics of it and getting people up to speed. But this time, I'm going to assume some knowledge from the audience and just really get into the nuts and bolts of that, because we are well into the meta now. So we at Blockworks have a digital asset treasury company dashboard there. And in preparation for this panel, I went in there and just wanted to start to count out, all right, so out of the amount of DATs that we cover, I calculated that 61% of them are now trading at a discount to MNAV. So with that as the context, I would love to just hear from you all of what does that say about where we're at in terms of this meta, and what are some of the implications from the industry? Anybody want to jump in? Just go for it.
Yeah, I'm happy to. I mean, I think we look at DATs as being individual investments, and there's actually a power law distribution on returns within the DAT space. And we can go into some of the details of this, but the trading volume that a DAT sees once it's liquid is a key component, and actually before its registration goes effective as well, is a key component of the health of that DAT. And if you look in the ETH space, for instance, you have the largest DAT in Bitmine. The next largest is trading 1/10 of the volume of Bitmine. And then the next highest trading volume DAT after that is trading 1/10 of the second one. So a steep drop off in trading volume. The trading volume is important because that's what you sell your at the market facility into. That's where you issue primary shares, raise capital, and then use that capital to buy the underlying token. So we've taken the view from the start that you're going to see differentiation, and you're seeing differentiation. A few big winners, and then a lot of DATs that will be very helpful for ecosystems, but we think of them more as ETF pluses rather than having a 10x type return from the pipe price.
Yeah.
Go ahead, Ben.
I would just add that I think like the state of the market can be just simply described with supply and demand. Simply put, there are just too many DATs and not enough demand to buy those DATs. There's no reason why you need like a 13th or 14th Ethereum DAT. There's not enough differentiation there. So what we saw is there are now roughly 200 DATs. Most of the top 20, 25 tokens have a DAT. You know, Bitcoin and ETH certainly, and Solana certainly have multiple DATs. And many of these DATs are now going through kind of a crucible moment where they're trading below NAV. There's not much differentiation. And they have to figure out, okay, what do you do? Do you sell your underlying digital asset and buy back stock? Do you issue converts to buy back your stock? Do you kind of do nothing and just kind of continue to, you know, to market your vehicle and educate investors? Do you start an operating business? But we're kind of at this weird point in the market where there was just too much supply that came online earlier this year, and now many of these DATs are figuring out kind of what comes next.
Yeah, agreed. I mean, I think I'll jump in, and you know, there's one aspect to this that I don't think people talk enough about is really it's a technical component, right? The flavor of DAT that has kind of emerged as the winner is, you know, pipe into an existing public company, typically like a micro cap that has 4 or 5 million shares outstanding, and you go issue a few $100 million in the form of a pipe. That's a lot of new shares. That's hundreds of millions potentially of new shares that are outstanding. And I think what some companies, what some DATs did early on is really just allow all those shares to register simultaneously. And these things take, you know, 45, 60 plus days for the SEC to go through its review process, potentially have any comments, and then those shares all register. And, you know, you kind of have, you know, especially if they're trading at a strong premium to MNAV, investors all racing for the exits at the same time, because not all, but many investors are really here for the trade, or at least want to take some money off the table because they see that high premium. And so when you have all those shares register at the same time, selling pressure into the market is going to drive it down until it finds that bid. And frankly, there's just not enough of that bid available, which I think is partially why some of those are trading below MNAV, at least for now. I think maybe some still, you know, you guys might know, but some pipe investors might still be in the trade. And anytime that there's increased liquidity, which is a really important aspect to it, and we could talk about that post like pipe execution. But until you find that, I think people will trade at or below, or maybe slightly above MNAV until you flush out all of the money that wants to rotate out and find that new investor base. But it's that technical aspect in the beginning that I think people are starting to fix, and BM&R and others, orbs, have done a great job of fixing by putting in a kind of a 50% lockup for 30 days post initial registration. Yeah.
And there's a really interesting dynamic because we've been talking about pipes, but when you look at SPACs, we really haven't had de-SPACs yet within the DAT space. So I think there's a really interesting opportunity when the de-SPACs happen to actually see them trade above NAV, get trading volume, have more of a pristine, clean structure. It's a little TBD, but...
Yeah.
Yeah, no, I completely agree. I think one of the optical challenges the space has experienced is that the capital formation process itself in a pipe transaction has asymmetric information. And so your most informed and willing participants are the ones that are actually locked up and unable to kind of communicate towards the investment activities they would like to conduct. And so not only with the low float element, but there's actually no good information that can come out of those who are behind the wall that is able to tell the story, right? And so when you have a dynamic where the stock goes up a bunch and there are retail investors getting involved in a period in which the price discovery is not being perfected by actual price discovery of intelligent market investors, there's a little bit of a problem. And I think to one extent, the SPAC structure, its blessing is at some level that it is anchored towards the de-SPAC needing to first happen for it to actually become a live trade in itself. And so in some sense, if you're not able to have the volatility of the stock at the level in which there's kind of a mania of the low float dynamic, then I think there's a benefit we can accrue on the back end of it later when the consummation does happen.
Yeah, I want to take Seth's characterization of this power law dynamic that looks like it's likely going to occur, and just would love to explore and hear how you're all thinking about what I think we can all agree, and we're kind of hinting at this idea of some sort of consolidation that is likely to occur. And I'd love to hear how you're all thinking about this. Do we just see the situation where, you know, you got MicroStrategy on the Bitcoin, you got BMNR for ETH, perhaps, you know, Forward for Solana, and you get these few winners for each asset, and they go forth and you know, through various ways potentially acquire some of these at a discount? That could be pretty accretive. Would love to just hear how are y'all thinking about what that process might look like. Go ahead, Ben.
Well, so one very you kind of framed it as like if a DAT is trading below 1x MNAV, let's say it's trading at 0.9, and someone comes along and does a stock-for-stock merger to acquire that company, that's effectively like buying the underlying digital asset at a 10% discount to what you could buy it at in the open market. So I think M&A starts to come into the fore when these things trade below 1x. That's if you're let's say that's if you're a Bitcoin DAT acquiring another Bitcoin DAT, it would make sense in that scenario. There's also kind of cross-asset, more hostile DAT M&A that I think we'll see play out, where if you're an Ethereum DAT, you acquire a Solana DAT, you sell all the Solana, and you rotate into ETH. So I think you'll start to see that game played as well. But so I think that's like the most logical way things consolidate. And I think like what will catalyze a lot of the consolidation is a lot of the DAT sponsors are highly mercenary. Like this is like their second job, right? They did a DAT because like they saw it as like a way to quickly make money. Their shares are under a lockup, and like if they can just like hand off the vehicle to someone else, to the winner, I think they'll want to do that rather than running like an irrelevant like 7th, 8th, 9th largest DAT in a certain asset category. So.
Yeah, to Ben's point, I think we're already seeing signs of those happening. There was an announcement by Strive acquiring Semler Scientific in the news on a share-per-share deal. So it's already happening. I think, though, I have a slightly nuanced take as to kind of how many categories there will be per token asset. I say it in the sense that because these entities are ultimately led by operators, there is an element to path dependencies for each of these treasuries achieving different outcomes that serve different client or investor-based needs. And what I mean by that is, and when you buy Bitcoin, right, like you don't really need diversification beyond maybe counterparty because you care about the custodial relationship, but Bitcoin's Bitcoin. If you're trying to take different kinds of risks on top of that with a managerial level, then I do think there is some benefit to having different operating diversifications as well. Take, for example, right now there's preferred equity that Strategy has issued, and people seem to really like it. And you may then want to have more of the kind of economic exposure, but maybe you don't want to just bet the horse on Sailor, right? Like that single key man risk might in itself be a detractor. So you do actually want to pref from another well-run DAT just from a diversification point alone. I think there's a real possibility that could happen, but to Ben's point, there's probably some scale velocity that you do need to escape, right? Being a public company is not cheap. And so there is actually a minimum market cap threshold that I think every DAT needs to accomplish to be able to afford the privilege of being a public company. But once you get past that, I think there is room to imagine there is some diversification benefits for the different strategies that might be pursued along the way.
Just I want to touch on Ben's point earlier. Consolidation will happen for sure, but I don't know how soon that's going to happen. I think it's going to take a little bit of a longer time. If you've been in the DAT world over the last several months, which all of us have been, and I'm sure many of you in the crowd have been, it's only been like 7-8 months of real DAT play. It's felt like a lifetime. I don't think a lot of us have slept very much over the last 8 months, so maybe it feels like 2-3 years. But the reality is we're still kind of early, and these deals are just starting to close. Like company management teams are just starting to get their footing and understanding what the public capital markets are like, and then thinking about how do I generate value. And I do think there's like a people element and like a pride element of these folks, the sponsor groups who have started DATs, and they want to prove to the market that, hey, I can drive value for my investors. I don't want to trade. I don't want to just give up and trade at like 0.8 MNAV without trying. I think it's too early. So it will happen, but it's going to be a lot harder to get M&A done in the space in the near term than I think people may believe it is.
I think one of the elements that we're finding is super important. So we say structure, which is basically the selection of the shell, again, going to the pipe structure, execution, and then the chairman. Those are the three key elements to kind of hit that flywheel. And I think like there's a real shortage, and the chairman is important because we're talking about these DATs really are creating a bridge between traditional finance and crypto. They really are leading traditional investors to learn more about what's happening in crypto, to understand what's happening at the underlying protocols. They need trading volume to be able to engage. What you were talking about, Jeff, on the pref side, it happens in common as well, right? If you have a DAT that's only trading a few hundred million a day, and a buy-side firm that has 10, 20 billion AUM, they might actually need multiple DATs in the same asset to be able to get to their full position. But the chairman is really important for helping on that education process, going out marketing to institutional investors to the buy side. And there's so few people right now that have that network, either a traditional sell-sider who has a network on the buy side and is bullish on crypto, or a former CEO or former CFO, again, who's made a lot of money for traditional buy-siders, has a great reputation and understands crypto and blockchain and is willing to put their reputation out there. It's a really small group of people, but the positive dynamic is that pool of potential chairmen, potential like spearheaders of that education process is only expanding on a month-by-month basis.
Yeah.
So I want to ask about one of the key considerations that comes up when these DATs gets released for a certain coin is one of the key considerations for the potential marginal buyer on the open market is, all right, so as this deal takes place, where are the tokens actually coming from? Are they raising a bunch of cash that they're going to go into the open market and buy the token? Are they going to do an OTC deal with the foundation? Where are those coins coming from? Are they coming from VCs that are locked in some sort of OTC transaction there as well, which might be good for just the lack of supply hitting the market later down the road, but maybe it's not creating that marginal increase on the open market. Would love to just hear about how do you think that right balance is between those three? Who wants to grab that one?
Well, I think the answer is like it's coming from all three of those categories. Now, like I think they each serve a different purpose. Like often, like when one of these DATs gets announced, or even before it gets announced, you start to see the spot token, the token behind the DAT run up in spot markets, almost like front running the purchase. You see also many of these DATs basically take locked investor tokens, receive those in kind, maybe at a slight discount to market prices. That helps them blend down kind of the MNAV for these pipe investors. I think, generally venture investors, think about it as like, look, they have a locked up asset that they can't sell. Maybe they're on like a 2-year lockup. They can put that into a DAT and effectively accelerate their lockup period, accelerate the liquidity profile on those tokens. So you've seen a lot of that dynamic. And then lastly, many of these deals, like bankers, and Christian could probably speak to this better than I could, but you kind of want to price the deal around 1x MNAV. And so oftentimes foundations who are highly incentivized to get DATs into the market are willing to offer tokens from their foundation at a big discount to market prices. The way they think about it is, look, these DATs are effectively permanent capital vehicles. They have very, very long time preference. They're never going to sell these tokens. So they don't underwrite to those tokens entering the market, but they're able to put them in at a big discount to kind of get these DATs from 0 to 1. In terms of what the right balance is between those three, I think it totally depends on the DAT itself and what asset they're buying. Obviously, for Bitcoin and ETH, There's no foundation that can sell discounted tokens. There are no locked tokens, but certainly for the longer tail of alts, that dynamic starts to come into the fore.
Well, where I've seen, yes, it's definitely a mix, and you're seeing investors come in with cash, investors come in with the underlying, and then foundations participate. Where I've seen the most successful outcomes, especially in the beginning, and frankly, it's been tougher, right? For the altcoins, they haven't performed as well as maybe the ETH or the BTC plays. But where I've seen the most success is, roughly about at least 50% of the investment comes in cash, and then the rest in kind, whether that's contribution from investors or the foundation. And I think it's because of that, almost like the reflexivity that occurs. You take the cash, you use it to go buy a token in the open market, which drives, should drive the price of the token, increases the book value of the company, which should drive the share price. Of course, combined with the execution of having your chairman, having a good PR strategy afterwards, that creates the flywheel that I think few people have been able to perfect, but yeah.
So it's actually interesting. I think a little adjacent to your question, Felix, but I think the pipe size gets priced in pretty efficiently.
Yeah.
Right, so the market sees a data is coming that's 500 million. It's going to buy 500 million SOL or get it in one way or another. The market understands what that impact is, and you get that move pretty quickly into the launch. What doesn't get priced in is that flywheel. So if you're one of the DATs that's able to, and what do I mean by the flywheel again? I mean trade at a premium to NAV. And actually have trading volume so that you can actually monetize that premium. If you're able to get that flywheel, that's what's not priced in. That's what gives you the sustained move higher. That's what happened in ETH when you had SBET, BMNR, ETHZilla, all of those coming at once.
Jeff, anything to add there?
No, I agree with everything everyone said. One thing I might add is the flywheel also has to be authentically organic. Yeah. I think this is the part that sometimes crypto investors are hypersensitive to, right? They're really just very tuned to this mercenary nature that the crypto VC ecosystem can operate in, and they're conditioned a little to be skeptical. And so I remember at the very beginning of the due diligence process, people would ask about whether foundations would participate in these DATs or not. And initially, it started off as a positive signal. I remember people were like, oh, okay, the foundations, that's a good thing. It's like they're king-making this particular vehicle. And then the meta changed over time. It was like, wait, so now the foundation is actually kind of doing mercenary things to the vehicle, to which who's subsidizing that activity, and do you then not want the foundation involved? And so people can't make up their minds. And I think this all goes back to this idea that people want to believe they invest in something with transparency as to knowing how that flywheel is made. So it's not just the investors. There's other dynamics too, where outside of Bitcoin, where if it's a proof of stake operating system, there's things that can earn income by being a validator as part of the system. And there's affiliate dynamics there that people have raised questions about as to, well, who's running what and which left pocket is going to which right pocket. And then you see things with asset management contracts where you see, wait, is the pipe investor then somehow being involved on the back end through an asset management contract of those treasury assets? And they're asking all the right questions. I actually think this is very important that investors know what they're doing ultimately with their own capital to support. But this all goes back to why I think, Seth, to your point, the seasoned kind of operators behind it matter so much, right? This isn't just an ETF where you buy the asset and it wraps in a cheap, transparent, cost-efficient structure. It's actually run by human beings. That's right. And human beings who are going to, for years, build value accrual mechanisms on top of it. And that litmus test of whether this is a trustworthy endeavor or not is a hugely important one. And so that organic flywheel, I think, is what people are trying to understand as close as possible.
Yeah, so one of my goals with this panel is just to, we throw around the word DAT, and I think there's this misconception that people view that all as, there's 1 DAT, 2 DAT, 3 DAT. They're all the same, but they're not at all. There's actually a lot of different structures and variations of it. Seth, you mentioned earlier how the most established one these days that we landed on is this idea of a private placement or a pipe going into a public microcap. And one of the key criticisms there that has been talked about is just the lack of transparency around what those deals truly look like in terms of, all right, so we get these pipe deals, and the investment bank that underwrites it, they get their fee, but we don't really know how long are they locked up for in those pipes and the like. And so I would just love to hear from you, Evolve. How do you think we can just elevate the transparency around those deals so that the average investor who's buying on the public market can get a better understanding of what does that supply-demand structure look like for these shares?
Yeah, I think there's a key element of transparency. Look, the equities markets have a lot more transparency than what we have in crypto markets to begin with. I would say, that said, you have to read the filings, and not many people read filings.
Or sometimes they read it and they actually totally misunderstand it.
That is
and then
well.
crypto Twitter, of course, has its own kind of feedback loop that's incredibly recursive.
I remember with the SBET S3, the way the S3 is presented, it shows all investors, a theoretical where all investors have sold. And crypto Twitter was running with that, saying everyone is selling out.
That's standard on any S3.
That's standard on the
You're registering
S3.
all
right.
shares for sale. Yeah.
So I think that transparency is there, but there's definitely an education process. This is a new approach to crypto assets, and the idea that you might not want to buy in at a big premium to NAV when the pipe investors are not liquid yet is something that people figure out as they go through the documentation or the filings, and as they invest in a few of these.
Yeah, I mean it's mostly all. I mean it's in there, right? It's in the footnotes. It's in the definitive documentation. A lot of it is in sometimes sophisticated legal language, and parsing through it isn't necessarily the easiest thing to do. But I think what folks have failed to do, especially more retail, is try to understand what that actual MNAV calculation is. They kind of buy on the hype. They see, the DAT's trading at, $30 when it was trading at $2 a share, and they're like, this is great, this is going to the moon. But the reality, what that says is it's probably trading at like a 20, 30 times MNAV. And that, fundamental analysis isn't really being done. So I don't know who needs to do this, but there's, Twitter personalities out there that I think could do a better job of educating the market.
I agree, and I would also add that, I actually think crypto is more transparent than, in many cases, than TradFi. I mean, if I want to know what's going on with Athena or Aave or any on-chain protocol, I have real-time, transparent, auditable, wallet by wallet, block by block, on-chain data. The issue with these DATs that I find is even with perfect disclosures, even if you do read all the footnotes, you could ask an analyst at Blockworks and an analyst at Masari what the MNAV is on BMNR, and you get like two different answers. Maybe one of them is including undeployed cash in NAV. Maybe one of them is, including like RSUs or options. Maybe they're converting the options under like, treasury method or some other methods. They're different methodologies, and so it is very difficult for us. So we just internally tried, we built our own DAT dashboard, and we tried desperately to automate it. But the issue is like what these different DATs disclose can be quite different. And so it's really a manual, for us at least. Maybe there are people that are better at it, but it's very manual, bottoms up, in terms of understanding exactly what MNAV is at a specific point in time, not to mention like the timing mismatches on ATMs and share counts. So I think more disclosure is needed, and the beauty of public markets to some extent is, teams can be more transparent. I think the best teams like we've seen, create public dashboards that are, you can visit from their website that have more detailed granularity around, what they own.
The one thing I would say about that is I agree, but there are regulatory restrictions about what you can disclose. You have to, in some cases, you're going to have to wait until the Q or the quarterly filing to actually disclose what's been done over the past, quarter, which makes it extremely difficult. And I think the other part that makes it difficult is because we're so early on, the kind of like the TradFi or equity capital markets data sources don't account for crypto. Like on Bloomberg, you could only really see, if you're pulling from Bloomberg, for example, you only see the price of Bitcoin or crypto assets, but it doesn't pull like how many of the underlying tokens that somebody has. So I think there just needs to be more development in this market and integration between TradFi and crypto for that to actually happen. But I totally agree. It's difficult. Us as the bankers, we're structuring a lot of these deals. It's very manual.
Right.
I sympathize with this completely, and yet at the same time, I think part of the problem is we treat this MNAV concept as if the starting point of a conversation as to understanding value, when in my opinion, actually, the MNAV is the output of something that will happen if you're actually able to deliver something worthwhile. And so part of this is we're starting by wanting to know the answer without realizing, well, how do we actually even get to the point where the MNAV means anything, whether it's a premium or a discount? In other words, strategy at some level, I think, set the tone for what an MNAV is because it was the first and the most scalable, successful model that has been emulated. But I don't think it's the only model that you can succeed by having MNAV premium by financial engineering on the liability stack alone, right? That's one version of it. But another very intuitive version I think all of us in this room can understand is if you're able to generate yield on your assets in a durable fashion that has long-term terminal value, that itself has a premium. That's literally just DCF 101. And so in that sense, if you're able to deploy some abilities for earnings power, then the MNAV premium will happen as the output of something that was worthwhile. And I think at this stage, when most of these companies are nascent and haven't been able to yet demonstrate the possibilities we're imagining here, the starting point of it being MNAV is a little bit challenging because it's the wrong kind of start. That's where we should end up. It's a privilege to trade at an MNAV premium, not something that you deserve at the very beginning to be able to go and engage in the financial engineering on the back end of it.
Jeff, that's a good segue into, I want to start exploring the future of where we go from here on out, and just trying to understand what are some of the methods to go about capital raising. And obviously we have the Michael Saylor strategy roadmap established, which is equity issuance and then convertible debts and now preferreds. And obviously that's one roadmap, but then as you say, there's also these methods of, all right, well, let's go for a token that has an inherent staking associated with it, and what can we do there? Or, go with what the forward guys are doing, which is, all right, we're going to start to do some stuff actually on-chain and DeFi and elevate that further. So I'd just love to hear how are all four of you thinking about where we go from here in terms of innovation, in terms of capital raising?
Yeah, I can kick it off. I think for ProCap, the way we're really thinking about it is we're trying to be like a modern permanent capital vehicle that happens to be denominated with Bitcoin as a unit of accounting and build a durable kind of business around it for the long haul. And it sounds really simple, but that's at the end, the execution engine that we're driving. And it starts at first generating yields on the assets to which I think people deserve the chance to earn authentic growth of the asset on a per share basis. When you're able to generate true Bitcoin per share without actually engaging in financial engineering on the liability side, people will immediately understand, oh, I understand what this is. It's like an ETF that's just growing by itself to get more Bitcoin into the wrapper. And people will find value in that thing. And you know what? It's really hard to find yield on Bitcoin because Bitcoin is pristine collateral. So when people say, oh, Bitcoin yield's only 2%, 2% on something that is hard to earn because it's actually very valuable and scarce and not inflating is a big deal. So the other question is, if you're able to generate 7% on a DAT that is because it's different in its consensus mechanism, there's a real question there about like what is the value capture there versus something else that is actually scarce, right? And so if you're able to do that and generate return on those assets, then I think you'll have the chance to play with the NAV premium to engage in some financial engineering to increase operating leverage on the company. Strategy has 4 different pref shares out there. Strategy has been able to find different ways to build audiences around those instruments, but I think over time, there will be other people who will tinker it differently to see what works better in different circumstances or what features might not be useful. And I think you'll see some diversification on that side. And then, only then, if you perfect the return on assets and liabilities, then I think the true kind of core story is the return on equity, which is there a chance to actually grow your operating cash flow by running a business to which that cash flow can be reinvested to actually then buy more of Bitcoin or whatever that asset that you're acquiring. And I think that's kind of the roadmap in which there's levels to graduating to earn that privilege, but ultimately the long-term state is to be a permanent capital vehicle for which the operating cash flow can help you accrue more of the unit of account.
I think it's a great point, and people have been kind of tinkering with this idea of Bitcoin Hathaway, where you go acquire cash flowing businesses that maybe don't have a lot of growth but are generating strong cash flows with even margins over a long time. And how do you return capital to investors? Is it through the form of dividends, share buybacks, or do you go reinvest it into a pristine capital like Bitcoin? I think there's some companies that are going to go that way and probably have to go that way, simply because at the current moment, most DATs do not have the liquidity profile to go do really interesting financial engineering in the form of different types of leverage like MicroStrategy. I mean, the reason MicroStrategy was able to do these syndicated converts is because they were selling volatility. They were they're really the only large DAT trading billions and billions of dollars of volume on, an asset that its underlying collateral was like an 80 vol at some point. I think it's come down over the last few months. But because you have that volatility, public market investors, convert investors could go long the convert. It's effectively a synthetic call option, and then they go short the stock in their delta hedge, and they play with that delta, right? That's how they earn their yield. But most DATs at this point don't have that type of volatility, don't have that depth in the equity capital markets, so they're going to have to find other ways to generate the yield. The proof of stake DATs have that inherent yield from staking and going and doing interesting things in DeFi. But the way that you find capital raising right now, it's like maybe one-way converts with one investor. It's a little bit more expensive, a little more structured, but generating that volume and liquidity should be like goal number one for these DATs, so that they find a strong shareholder base that starts trading the stock. And at the end of the day, having that liquidity is the most important piece.
I think to kind of approach the question from a different angle, I think we're probably in the very, very early phase of institutional interest in crypto. So I think the pool of traditional financial capital that's looking to invest in a Bitcoin vehicle, an ETH vehicle, or altcoin vehicles is a fraction of where it will be in 2 years, 3 years. That's going to be a big driver, I think, of valuations in the space, of trading volumes, of the opportunity set or decision tree around accreting NAV per share. So it is a secular growth segment of crypto, and we're in the third, fourth month of it.
Yeah.
Yeah. Right. Just to level set. So MicroStrategy is going to be in every business school case study around capital structure and capital markets. They're the largest ATM issuer in the history of capital markets. They're the largest convert issuer in the US or globally today. I believe they're also the largest issuer of preferred equity instruments. Their options chain has the same open interest as MicroStrategy. So they've tapped into something very, very special. They're also getting passive flows. So people that are buying, the NASDAQ 100 are buying MicroStrategy agnostic to what their NAV is, just because they're running rule-based funds. And then, indirectly, as some of that capital is then going to buy Bitcoin. So MicroStrategy, though, is in a different camp, but I think it's reflective of what the menu of different options there are to increase NAV per share. And look, and it's not exactly your question, but I think our thesis on the space, on DATs overall is, look, I think the easy money's kind of been made. Most of these pipe deals were kind of heads you win, tails you break even. But I think now going forward, to echo Jeff's point, I believe that the best DATs will be able to durably outperform the underlying asset by increasing, units of Bitcoin held per share of fully diluted common stock, or units of ETH held per fully diluted share of common stock. I think very few will, but the very high quality ones are capable of doing that. And so it's about identifying the right team and the right capital market strategy. And then I think you have something that can potentially, generate alpha.
Yeah. All right, 1 minute left here. Just
to that point, just quickly, I think there's a perception disconnect where there's a view that you create a DAT and it's kind of like creating an ETF, right? And I think the rarity of the DATs that are going to have good businesses that can accrete that NAV per share, that's that power law dynamic. It really is 1 out of 10, 1 out of 100.
Yeah, and I think that's key where, some people, obviously with the government shutdown right now, which is stopping a lot of the ETFs that were supposed to be launched quite soon. And yeah, it's a key distinction between the two of, you have the DATs and then the ETFs as well. So I think that's key. All right, that's all the time we have. Guys, thank you so much for that. Great
Thank
State
you.
of the Union.
Thank you.
Thanks
Yeah.
again.
Thank you.
Appreciate
Yeah.
it.
Thank you.